Thank you so much for the kind intro, Dave. I'm not the man of the hour, though. These two are. We have the founder of Ripple, Chris Larsen, and we have its current CTO, Stefan Thomas. We're very, very excited to have them. This is going to be an awesome talk. A little kind of brief intro. Chris got his MBA from Stanford. He started eLoan, which is kind of a mortgage lender. It was actually the first platform to freely give out FICO credit scores to its users. He started Prosper, which is actually the first P2P, peer-to-peer lending marketplace in the US. And famously, he co-founded Ripple Labs, which is the subject of today's talk. So we're really excited to have Chris here. Stefan Thomas is the CTO of Ripple Labs. He was the CTO of numerous tech companies like Elode and TxtBear. He founded WeUseCoins, which created this kind of Bitcoin primer video, which amassed 8 million views and was a primer for a lot of people to just learn about kind of the basics of Bitcoin, and it kind of blew up on the web, so I'd check that out. And he's a board of directors, he's on the board of directors, sorry, at the JS Foundation, and he's the current CTO of Ripple. Ripple describes itself as the only enterprise solution for blockchain. It allows institutions to send money globally in a fast, frictionless, and cheaper way. And its kind of broader eventual aim is to create an internet of value, which I'm really excited to talk to both of these guys about. So without further ado, please give a hand for Chris and Stefan. Awesome, guys. Can you guys just give us kind of a brief bio in your own words, your career and how you came to found Ripple Labs and then get involved?
Great, happy to. And first of all, thanks for having us. And thanks for not making a Bart Simpson joke. Appreciate that. Yeah, as you mentioned, we've been in fintech for about 20 years now, with kind of two startups previously, eLoan and Prosper. Kind of the common thread there, those were focused on the consumer. Ripple obviously is focused on enterprise, and there's some learnings that I had from that I'll share later. But the idea there was using the internet to democratize finance. I think we did a lot of good there, but we were always limited by just a fundamental lack of infrastructure in fintech. So kind of in my view, fintech really hasn't even started. It has sort of been a stepchild of the internet boom, because fintech really has to involve both data and money, and so far you've only had the ability to move data. So there's both a lot of excitement, a lot of frustration that we couldn't go further. At the same time, we was always keeping an eye on what was going on with virtual currencies. And Bitcoin obviously was a real breakthrough, but there have been a lot of attempts over the years. And so we were watching things like Linden dollars, which was currency and that kind of existed in the early days, Second Life. Phil Rosdale, kind of an amazing guy, still the coolest guy in crypto, right? Things like Vermont dollars, kind of this idea of local currencies in a very small community, super interesting. Obviously beans and floors, which were two big, well-funded projects during the first dot-com boom that sort of failed spectacularly. But it just seemed like it was a matter of time before you'd have a global digital asset with no kind of government backing and no counterparty. As far as Ripple itself, the roots actually go back to about 2004. There was something called the Ripple Project created by Ryan Fugger, a Canadian gentleman. He was just really a neat guy, and he tried really to kind of give birth to this idea of a peer-to-peer platform for people exchanging their own credit and essentially their own currency. Every person would have their own currency. Super interesting concept that was a big part of what influenced us. Kind of fast forward to 2011, and there was these three geniuses that got together, Arthur Bretto, Jed McCaleb, and David Schwartz. And this is, of course, after Bitcoin was created a couple years earlier. They were fascinated by what Bitcoin did, but they were frustrated by the enormous waste of energy that is sort of at the heart of mining. That's a core part of Bitcoin. So they set out to build a more efficient consensus algorithm, and they came up with something really beautiful. They also were inspired by what Ryan Fugger had done at the Ripple Project. and kind of also brought in that idea of kind of pathfinding algorithms so that anything of value can be exchanged along with that digital asset to really, I think that was kind of the birth point of this Internet of Value.
The Untitled protocol, which we'll show in a little bit, actually is almost like an overlay protocol over blockchains, but then also traditional financial systems. And that allows you to innovate in different parts of the network independently instead of having this sort of central governance model where everyone has to agree to any rule changes that are happening.
Yeah, I think this is like a critical point. I think we came to the realization that a blockchain was not going to be the solution to the biggest problem we think the world has right now in this whole fintech area, which is there is no Internet of Value. And why blockchain, and a lot of people talk about Bitcoin's going to be a new protocol for money. Well, it's really a database, right? So a single database or a single network cannot be the network of networks. And so that was kind of the big flaw, and that's what led to, I think, Stefan having this kind of aha moment of the need for something like ILP, which was a dangerous moment for.
It was scary at first.
Yeah.
It was like we were out there promoting this asset like XRP, like telling everyone, hey, you should put all your balances on this ledger. You should do all your transactions through this one system. And we knew the friction from that, but then again, like stepping back from that and suddenly saying like, oh, there are going to be many systems was very scary. And so we actually waited almost a year to publish the white paper until we had, in our minds, have resolved a strategy around what's XRP's role in this new world, and how do we make sure that our technologies are still needed and is still necessary and can benefit this new world. Like, how do we re-architect everything to serve this new world? So I think we're still in the process of like rolling out all of the different pieces, but it was that sort of 1 year period from, I would say, mid 2014 when we first had that realization to October 2015 when the white paper for Interledger came out, where we tried to kind of put all the pieces in place for it in our hands.
Because remember, Ripple always was different from Bitcoin in that you could put anything of value in it, right? So this idea of kind of, we would call it IOUs or balances, but really being value agnostic, and that then being the engine for the exchange of that thing of value. But having the combination of ILP with XRP, we think that's kind of the killer formula.
Yeah, so now you can have any type of value, like any currency, but also any type of ledger. So like anything from a centralized ledger to a blockchain, et cetera.
And if we look at kind of stepping way back, kind of the macro problem that we think, again, the world has, this lack of an Internet of Value, you can kind of argue that this gets to the heart of the problem with globalization, which is obviously under a lot of stress today, right? It's kind of not working for a lot of people. And we kind of, we don't think of it as like, well, globalization's bad. We think of it, globalization's actually incomplete. Until you have an Internet of Value, you really can't have true globalization. You sort of need these three core interoperability technologies working all together. You need interoperability of data, of goods, and money, right? So the world today, of course, has interoperability of data. It's completely transformed the world over the last 20 years. It has interoperability in goods through a simple thing called the shipping container, which before that was invented, shipping stuff was incredibly inefficient and labor-intensive. Stuff would arrive at one port, had to be ripped apart and reshipped. And with a shipping container, you're shipped to train, to truck, any port in the world. You have interoperability goods since the 1950s. That's sort of what an Internet of Value is. It's like the shipping container for value. And again, that can't be a blockchain. A blockchain is like a single shipping company that will, you'll max out that shipping company, and you'll have a dependency on that one shipping company. A shipping container, you can create endless shipping containers. It has no effect on any other shipping containers deployed. That's sort of what ILP is, almost the ultimate decentralization. Right. So that's kind of how we're thinking about it.
For the technical people in the audience, it's a stateless protocol, so you can literally just run it over different systems. So it doesn't keep any balances, etc.
And then we think really good things happen when the world finally has a full kind of a globalization platform. But this has to happen. And again, what is this meaning now that we don't have it right now? It means, we all know sending $50 to Europe is kind of impossible, right?
Yeah.
We know the example of the Airbnb host in Tanzania who should be making $29 on a rental, and by the end of the day, $9 is showing up. This is an actual example, right? So that's a problem with relatively big amounts of value. Think about the 2 billion people in the developing world. The Gates Foundation would say they need to be able to send 50 cents to be real participants in the global economy. Take that even further, if you think about all the connected devices and applications that probably should be empowered to send value, that might need to be, you know, a thousandth of a penny. That's just not possible until you have this Internet of Value in place. So the world is being held back by this, and we think that's the true breakthrough that this whole, whatever you want to call this industry, really is all about.
There are some detractors of Ripple that say it's kind of the centralized blockchain or the enterprise blockchain. You know, a lot of Bitcoin loyalists and Bitcoin in general might have come out of kind of an anarchist or cypherpunk kind of movement early on. Stefan is part of that. And so that's kind of the general criticism. So I wanted to give you guys a chance to respond to that, and then I'll combine the second question because Stefan has an awesome presentation he's going to give. The second question is, we are living in a crazy kind of environment in terms of cryptocurrency, just speculation on the price of tokens and blockchains. Do you guys think we're in 1999 right now? Is this the you know, kind of a dot-com bubble that we're experiencing? So yeah, those two questions.
Okay, so I'll take the first one. You can
Sure.
talk about .com. So first of all, the enterprise part I take as a compliment. I think that's precisely what we're trying to do. Is we're trying to build the first blockchain that can actually be used for real, you know, real use cases. You know, like when you think of, you know, any distributed system, when you take a distributed systems class, the first thing your professor will tell you is like your distributed system is still only going to be as good as the nodes it runs on. And so if you think of Bitcoin miners, they're only incentivized to basically hash as efficiently as possible. They're not incentivized to provide physical security for the data centers. They're not incentivized to make decisions in the interest of the network. So they have a very pure incentive to just hash as much as possible, get paid, rinse and repeat. And in the case of Ripple, since the validators are chosen by the users, if a validator, for example, votes against a block size increase or something like that, if there were an issue in Ripple, then you would eventually find that users would no longer add that validator to their list, and so that validator would slowly lose influence. And so it's not as much of a system that's like tailored to users like Bitcoin is, where, you know, anyone can just run a node and it just auto-configures itself, connects to the network. You do have to do that validator selection manually. You have to think about, you know, politically speaking, like which validators do you want to empower with your node, et cetera. So it is more targeted at like, you know, actively being managed by companies, things like that, things of that nature. But I think the reason that that makes a lot of sense is because when you actually go out there into the market, you know, the evil people, you mentioned I'm an anarchist, like, you know, so I really want to empower people, right? But the people that you got to fight are not the, like all the banks. They're a few, you know, very, very powerful players in the market that sort of take a little bit off the top. And those are the people that you want to bypass. And then everyone else, like there's a lot of small banks and regional banks and so on that we've talked to that are really trying to provide, you know, better user experience. They're really trying to provide lower fees, et cetera. Those are the companies that we want to work with and empower. And it's not just banks, it's payment providers, mobile money providers, and so on. So that's kind of where that different approach comes from. And on the centralization point, I would kind of say that there are a lot of different definitions of centralization, and you know, we're sort of going down a list of meeting more and more of them as we progress. One of the ones that we don't meet yet is that we still run a majority of the trusted validators, but that's something that we're this year going to start rolling out in terms of we have already got a lot of third-party validators running, so people are going to start trusting them this year, and so this is just one more step to kind of go in that direction. And I think if I compare it to where we were with Bitcoin, like with Bitcoin, we had some level of decentralization, again, meeting some of the definitions, but not all. For instance, there's no geographic diversity. It's very concentrated in China right now. But we didn't have a very good roadmap in order to how to overcome that, because the system is really, you know, it's just sort of the incentives are set up in a I would now say, bad way. Whereas with Ripple, we have the incentives are in order, and so it's just a matter of like, you know, validators having the right, you know, amount of operational history, so people actually start trusting them, and us having enough confidence in the software to actually, you know, continuously let go of more and more of the reins here. So, I think it's. For Ripple, it's a clearer roadmap to get to a very high level of decentralization. So.
Yeah, and bottom line in decentralization is there's kind of a bright line. You know, if Ripple did not exist, would the network continue to function? Yes. So that's kind of that, you know, hard line of which side you're on. And then I think it's, to Stefan's point, a variety of kind of gradations from there. And then second, I think on what's going on in the market today, So obviously, a really interesting, time in the space. Clearly, there is a lot of speculative interest that's going on, and I'd kind of break that into kind of two parts. One is there's clearly a lot of almost like crypto day trading going on. It's almost like the days of the early internet with all the day trading. And I think if you look back on most people that were day trading back in 2000, I bet it didn't work out that well for people that were doing that. People shouldn't do that. You could lose you could lose everything. It's just not a good plan. People should not be putting their retirement money to work day trading, cryptocurrencies. And I think there's a lot of skepticism that you see out there. Nathaniel Popper, for example, of the New York Times, he writes about that skeptically, and he's right to be skeptical. So we think, that people should be very careful with that. But there's a second part of speculation I think is being now increasingly driven by institutions. So institutions, funds, we would call it the Wall Street tidal wave, is sort of coming into play here. And I think what's going on there is that very sophisticated people are saying, investors are saying, look, there's some meaningful percentage of this is in fact a second internet. And this internet of value can be as transformational. That's a longer term sort of call that's going to happen. So I'd say that's more constructive speculation. And I think those institutions and those kind of professionals, they've seen what's happened in this last 20 years of the net, the great promise, the overhype, the total bubble, the crash, and then kind of fast forward 20 years where we are today. If you look back, you'd probably say, probably the early promise was probably underhyped, given the impact that all of this has had on human existence. So, that's a more constructive view. Like the use cases for industries, enterprise, payment providers, and other things, that is coming on board. So I suspect that sort of ratio of sort of hopefully the long-term speculative activity and the use cases starts to look more like what you see in normal markets, because those things can actually work pretty constructively together. The last point on that I think interesting is in the first internet, that kind of started with institutions, VCs, and then Wall Street, and then kind of went on to sort of this day trader dynamic that you saw. This is kind of the reverse of that, actually. It kind of started with individuals, and now the institutional wave is coming on board. So that's a little bit different kind of flavor. But definitely I think the world's never seen anything like this before, so it's trying to grapple, like what are the metrics? What, is it, you compare it to Visa, you compare it to gold? Is it the first protocol that can be monetized? Lots of new questions.
Awesome, guys, really appreciate it. Stefan's now going to give an awesome presentation about what's in store on the technical side for Ripple, and then Chris is going to stay here. Stefan's going to come back, and we're going to do a little Q&A with the audience. So take it away.
So what this is trying to illustrate is if you deploy IntelliLedger on some network, and we envision that there will probably be sort of a global instance of it, just like the internet has a global instance, then you have these different nodes, these little blue nodes here, and we call them connectors, but they're basically like routers in IP. So they basically take in packets on one side, they look at the destination on the packet, they compare it to their routing table, and then they forward that packet towards that destination. Whenever you look at any kind of blockchain presentation, there's a pretty good chance you'll see some kind of graphic that has nodes connected by lines, some kind of graph. And you'll hear things like Bitcoin is the TCP/IP of money. And when we hear that, we cringe a little bit, because if you know anything about how TCP/IP works and how Bitcoin works, they're very different protocols that do very different things in a very different way. And so the challenge that we always have when we talk about IntelliLedger is it is actually a lot like TCP/IP. And through this little presentation, I want to try to convince you as to why I say that. But people already have usually seen some kind of blockchain presentation that already looks a lot like this, but is a little bit more superficial in terms of the similarities. And so if I want to send a packet into this network, I just send it to whichever connector I'm connected to, and it should find its way to whatever receiver I've put on it. So in that way, it's a lot like TCP/IP. Now you might say, okay, so you're routing these packets, but how does actual money really move? So the way that that works is that once you have sort of a path and you're sending these packets, each link is responsible for its own settlement. So what we tend to do is if you have two connectors that have a peering relationship with each other, they're going to have this like packet traffic going back and forth. And so they're going to look at those packets, and then they're going to eventually settle. And for the core of the network, it makes the most sense to settle through a digital asset. And the reason for that is that they are very easy to move internationally across borders. You have very low costs in terms of when you move them. And since you're going to have a lot of inbound and outbound traffic, it makes sense to just stay in that digital asset to do all of your settlements. But of course, the majority of people, users out there, don't actually have easy access to digital assets yet. And so you do need some kind of some form of support for traditional payment systems. And the interesting thing is that all these settlement networks really do is, move payments across, or like move money. And so that's something that is supported by all the legacy payment networks. So what we can actually do is we can just aggregate to a greater degree. So we wait a little bit longer before we settle. And then we send one big payment across. So you see that kind of at the beginning here with the sender down there and the receiver in the upper right. Where those settlements are happening a little less frequently, and they're a little bit bigger, and they're probably a little bit more expensive, but they can settle lots and lots of these individual packets. And so with this architecture, what that means is that from an end-to-end perspective, we can send a packet at incredibly low latency. We can send it at an incredibly low incremental cost. And so that's really what makes it feel a lot like the internet. You can really just connect to lots of different services and pay for lots of different things without accumulating a lot of fees while doing that. And then sure, there's a settlement eventually, and hopefully these last mile sort of settlements will get more efficient, just like internet connectivity went from 56K modems all the way up to what we have now, where I have Google Fiber, so I'm very happy with that. So yeah, here's a little chart of like the actual architecture. And again, if you're familiar with TCP/IP, they draw the same kind of picture with the 4 layers, which is sometimes called the internet architecture. It's a little bit less detailed than the OSI architecture, but I won't bore you with that. It's just a reference for the people that know that. So the 4 layers actually work a lot very similarly to the 4 layers in TCP/IP. So I just want to go through those 4 and kind of to give you a sense of how this all works together. The way you should think about the interledger layer is that's essentially an abstraction layer. So that's basically the thing that you have all the different ways of moving money below it, and then you have all the different use cases for moving money above it, and it kind of brings them all together. So in the case of the internet, it would be the internet layer has all the different ways of moving information below it and all the different use cases building on top of it. And so now you can have all these different combinations. I can make a Skype call over my Wi-Fi. I can make send an email over my satellite internet. So it really doesn't matter what use case I'm using and which network I'm on. I can combine them in different ways. And so this is kind of doing the same thing for money. Okay. Now, on the application layer, this would be sort of the equivalent of like HTTP, SMTP. This is use case specific. You would make different application layer protocols for different use cases. So one that we've designed so far is called SPSP, or Simple Payment Setup Protocol. And basically all that does is it defines what an internet sort of identifier looks like. So think of that like an email address. And you could send to that type of identifier if you wanted to pay somebody as on a peer-to-peer basis, or you could build that into simple apps. It's not super efficient, so it's kind of like HTTP. It's sort of a general purpose application layer protocol. You could make a much more specialized one. So for instance, we did an experiment where we built payments into WebTorrent, so basically to pay the uploaders, but also the content creators, which I think is a really cool aspect of this. It's like it's efficient enough that you can pay a lot of different parties in the flow of whatever app or interaction that you're part of. And we'll see a demo of that in a bit. But I think this is where I expect a lot of variety is on the application layer. Now, we'll talk about the transport layer. So if you're familiar with TCP/IP, this is where you find your TCP. And TCP is really common to a lot of different application layer protocols that build on it. And it gives you some sort of basic services, right? It gives you sequencing of packets so that your data comes out the right order. It gives you retransmission. If a packet gets lost, it'll send it again, and so on. And we have a transport layer protocol called PSK2, and it does a lot of the same things. It's responsible for doing things like if you send a large payment, it'll it'll split it into smaller chunks and then reassemble them. It'll do things like retransmission of payment packets, etc. So again, like I'm trying to really get across, like we're copying from the internet a lot, and we have to give them a lot of credit, because a lot of the things that they do actually apply to money very well. Now, the interledger layer is kind of an interesting one, because that's where all the routing happens. And when we first started out, I'll tell you one anecdote about the design of this layer, which is when we first started out, we assumed that the routing would have to be quite different, because we're talking about money after all. We're not talking about information. And so we knew about BGP and how it works and so on, but we thought a lot of those things wouldn't be applicable. We wanted to route by the lowest cost path. We thought that that was the most important thing, was to minimize the fees. But as we're actually building it, we realized that if you optimize by fees, what can happen is somebody in the network just advertises an absurd rate. So they just advertise, hey, I can exchange $1 for 600 euros. Now that's suddenly the best path to take for absolutely every payment in the entire network. Now what do you think is going to happen? So that node's going to go down. Obviously that rate was never real to begin with. And so the whole thing just breaks down. And so one of the reasons for the way that BGP is designed is to make the length of the path one of the primary metrics. And what that does is, if someone advertises some ridiculous metrics, you're still only going to take down his immediate neighborhood, because for everyone else, it's still going to look like a big detour, a very long path that they don't want to take. And so it turns out that even for money, the length of the path is actually a very good proxy for all the other things you might be interested in, like how reliable is it, what's the latency, what's the fees. Those are all lower, or tend to be lower, for shorter paths. And so we can do exactly what BGP does in terms of routing by shortest path first, and then using other metrics to kind of tie break if paths are the same length, picking the best one. And we just basically add fee as another metric, just like the internet has latency. I already kind of talked a little bit about the settlement. The key thing to mention here is that all we need from the settlement layer is that it can transmit money. It doesn't have to be very fast. It doesn't have to be very cheap. If it's slower, we just settle less often. And just to give you some examples of the kinds of things we've integrated with already, there's a XRP PayChain plugin. So that's settling using the XRP ledger. That's the most efficient plugin right now. That's one of the reasons that we feel good about the strategy. Is like we're actually seeing in practice that our own products score really well on these different metrics. In terms of like what ledger would you actually choose for settlement. We've done a Lightning integration, so we did a little test where we actually connected the Bitcoin Lightning Network and the Litecoin Lightning Network together. If you're not familiar with Lightning, it's basically a scalability overlay network for currencies like Bitcoin. And then you could do something like ACH. You can even do cash if you want, right? So you can have a relationship with an interledger service provider where it basically says, like, I give you cash up ahead of time, or you give me cash ahead of time, and then we can exchange packets up to that amount until we reach that balance, and then we have to settle up again. Okay, now with all that prefix, I'm going to give you a bit of a live demo, and this is going to go fairly quick, so pay attention. Basically, what we're going to show here is the Easy Website Maker. Okay, so Easy Website Maker is an app that somebody put together. You just uploaded it to GitHub. And basically, it allows you to create a website from just having a little sketch. And now, obviously, we didn't build all the difficult parts, the AI parts. That's what you guys are for. But we did do all the payment stuff. So all the payments are actually going through Interledger. There's actual payment packets being exchanged. And we tried to visualize that a little bit later by having like a log of packets. And basically what this app does is I put in a sketch, and it goes to one vendor that's offering an API, a paid API, that can turn sketches into actual HTML. And then I'll go pay another vendor to actually package that into a Docker container and upload it somewhere. And then another vendor to host the actual live website. And then another vendor to buy a domain. And finally, we'll tip the developer. So I'll go show you what that looks like. So first thing I need to do is I need to pick my sketch. So I'm just going to grab one here. And so this is the sketch of my website. It's probably a little bit small to see, but it has like some text, and it has a little chart, and it has some more text. And just to be clear, again, like the AI is mocked out. We didn't actually create the AI just for the demo. That would be ridiculous. But yeah, in the future, this could very well be possible. So now I'm going to say make my site. And now things are going to happen very quickly. So it's going to upload that sketch to that AI. It's already done. And now it's uploaded the finished HTML that it got back to a service that turns it into the Docker container. And as you could see on the right, and I might do the demo twice just so you can see it again, On the right, you saw the total amount paid. This is in XRP drops, so this would be 1/1,000,000th of an XRP. So total paid would be 0.1 XRP, which is about, what is that, like 2 cents, 3 cents? Sorry, $2, $3. No,
20 cents.
Sorry.
20 cents.
It's like, yeah, it's like 30 cents or something. Whatever. So you can see like the individual packets, and there's a couple things going on. And I think I will run through the demo again just so you can see. So first, when we paid that AI, we paid a sort of one lump sum amount. And then the packager is actually a streaming paid endpoint. So that's a paid endpoint where as we send it data and we ask it to do things, we'll stream packets to it to keep it paid. And if we ever don't keep up, it'll like stop working until we pay it more. And then we deployed it to a host, bought a domain, and then sent a tip to the developer. And I can actually click this button here and then look over here. And as you can see, our website is now up. And I can actually show you it's like all of this is running locally, but we got a domain, et cetera. It's like set it up. So let's go through the demo one more time just so you can see kind of the streaming payments part a little bit better. So I'll pick the same website. So here on the right, you can see like the total paid right now is 500 drops. That's to pay for the AI. Now we're streaming to pay for the packager. So this is going in 250 drop intervals. And then we have a larger expense to host the website, 9,000 drops. It's over 9,000 to actually buy the domain. And then finally, we tip the developer 1,000 drops. And so if I make an app like that, I have a built-in business model. And I think that's really the key point to get across here is I think this will have a huge impact on the web, where think about if I start a convenience store, I don't need to think about what my business model is. My business model is people pay me when they come buy things. When I open a restaurant, I don't think about my business model. My business model is people pay for the food that they eat. On the internet, we have this weird thing where like there isn't a good way to charge people for using your website. And so we build advertising, we build subscriptions, and all kinds of hacky workarounds for like how to get money out of people just from visiting your website. And I think this will present a pretty efficient alternative in the future where people can just pay you for using your site. So that's it. And I can go back to this. Thank you.
Thank you, Stefan. Cool. Now we'd like to open it up to questions from you guys. Does anybody have any questions?
Thanks for the presentation again. Yeah, so there's like a lot of different coins that deal with payments, like Ripple, Litecoin, Stellar, for example, that I've heard of. Can you go like a little bit over what's the the basic differences between all those different payment platforms? And then also, do you see like one payment platform just dominating and we all just use one of them, or can these somehow like live in harmony, kind of like USD and euros and whatnot?
Yeah, maybe I'll do that. So on the second part, I think it's going to shape out a lot like what you're seeing with fiat currencies. I mean, you know, the world kind of has 4 majors, maybe 5 majors, and then there's kind of a everything else. And I think that probably plays out here simply because particularly with this sort of Wall Street wave that's coming, a lot of those institutions, they're not buying, how many, 2,000 different, kind of coins and platforms out there. They're sort of grabbing, I don't know, top 10 or 5, or it's some smaller number. And, in currencies, liquidity begets liquidity. All of this is about how much liquidity is kind of supporting these platforms and these currencies or commodities, whatever you want to call them. There's still a lot of debate on what they actually are. So I suspect that's going to accelerate, and that liquidity then attracts more use cases. Like for example, Ripple, the company, focuses on the enterprise use case, but we see these things. We see XRP as very much a general global digital asset without a counterparty. So you'll see more and more use cases popping up from different angles, and that just kind of drives more liquidity. So I think that's probably the way in my opinion, how it pans out. But,
yeah, I think the reason we developed Interledger and the reason we built an interoperability protocol was because of that exact realization. It wasn't going to be everyone using one system. There was going to be a number of different systems. And actually, behind it is another realization, which is, my goal has always been, to solve the problem of, the friction in payments, right? And so I realized that decentralization wasn't necessarily the solution because you see PayPal, they come out, they're free, then eventually they jack up their fees when they have an established market position. But then you see Bitcoin doing the same thing, not necessarily with as much sort of agency, but it still happens that way. And so what you got to think about is right now when you're on a payment network, you can only send money to the people on the same network. And that's kind of like pre-internet online services where you could have like CompuServe and you can email anyone on CompuServe and you can use any services that are on CompuServe, but you can't access any services that are on Genie, right? And so CompuServe has this like moat. They have a defensibility around their reach. And so that's really what you gotta commoditize or what you gotta attack. And so with payments, it's still that way today where like if you're on the same payment network, you can pay each other. If you're on different networks, you can't. If you want to pay from your PayPal account to a mobile money account in Tanzania, you're screwed, you can't. Yet I can totally go on my mobile phone in Tanzania and open any website in the world, right? So we need that kind of interoperability, and that's really what creates the competition that drives down the cost. The reason we think that XRP is going to have a role in this system is because we've been doing, I mean, not to toot our own horn too much, but like we've been doing really well in terms of like the performance and the characteristics of the protocol. So I think a lot of people will choose to use XRP if there is sort of a lot of competition. Whereas like right now you use Bitcoin even though it's expensive. You use Bitcoin even though it's slow. I think if there's a lot of competition, people will pick the most efficient, which would be XRP right now.
Yeah, add that as well. It's kind of in an environment where a lot of the volume, I think, is speculative. I actually think that kind of use case has a greater tolerance for cost, speed, kind of doesn't really care, right? Whereas as you start getting into kind of these use cases where you need like, millions of some kind of unit, that matters a ton, right? So as the kind of the ratio of real use cases to speculative volume changes, I think that dynamic becomes more important. Very true. Oh, sorry.
Next question.
Cool. Thanks.
Thank you.
Hey, thanks so much for coming. My question is around, so if you're talking about that XRP and cryptos are the internet of money, the big difference between money and data is that money is regulated, and banks certainly, if they were the equivalent of running the phone lines before, have a pretty big incentive to innovate and sort of get ahead of a change that is coming. So you could see them easily upgrading the SWIFT protocol to be able to move money internationally a lot quicker. And so I'm curious how you guys see specifically XRP living in a more regulated space. I think, crypto sort of took the world by storm, and governments are going to certainly respond the next year or two. So why do you think that XRP is going to be able to live in a much more regulated industry than data is? Especially because you could see banks upgrading SWIFT to be able to support, maybe like sub-minute transactions instead of transactions that take days.
Yeah.
I want to quickly question some of the premises in there. So I think a lot of the people in the room I think are very young, and so we grew up after the deregulation of data. So the internet came out, and a lot of the laws that were around before then, copyright law, cryptography laws, export restrictions around algorithms, things of that nature, actually got removed, and their safe harbors got created because the internet kind of posed a technology that was, on the one hand, very useful, and on the other hand, kind of in a legal gray area. So I think that the technology, just if you use it, it just feels so incredibly useful that it's hard to imagine how regulations wouldn't be built around it. I think that there's definitely an opportunity for people to be thoughtful and intelligent about how they approach the technology in the meantime. Like you want to be compliant, you want to do everything that you can to kind of stay within the letter of the law, but there are going to be ambiguities in terms of just the law is not written for these kinds of use cases. So I think that's one thing. And then as far as XRP, I think I'll hand it off to Chris.
Yeah, I mean, you're raising, obviously, a key part. And as I mentioned before, the internet of value is kind of equal parts capital, technology, and compliance. Compliance is hugely important. And the reason is simple. I don't think it's just because governments sort of want to have a monopoly. I think it's actually a question of, data is powerful, but money's more powerful, right? Data can show you, a life-saving medicine that your family might need. You can't buy it. Money can buy it. On the flip side, data can encourage a terrorist to do something awful. Money can buy the weapons, right? So the stakes are higher. which I think actually this is going to have maybe a more profound effect on Earth, good and bad. So regulators have got to be there every step of the way. This fantasy that somehow this is going to bypass governments and bypass compliance, you know what? That's just BS. And you know what? Nobody wants that. Nobody wants that. That is a champagne problem with a bunch of rich young people that can sit there behind their computer screens and like block out a lot of bad things that can happen. So it just can't go that way. And so I think we're trying to think about that, try to be pragmatic about that, because that's the only way we're going to have impact. And if you look at people that are trying to support what's going on in the developing world, they are very much wanting to work. They're not trying to go around. They're trying to work within the system because they know that's how you're going to have impact. So that's kind of the way we see it. Your question about SWIFT, by the way, the problem with that point of view is SWIFT only deals with the data. They have a correspondent banking partner that deals with the value, and that's off any sense of an Internet of Value. The whole point here is that something like Interledger and XRP can eliminate the correspondent, which is actually where all the juice is, right? That's where all the waste is. That's where the settlement risk is. That's where the failures are. That's where the time is. So SWIFT actually doesn't have the combination of capabilities to do what you're saying. Right. Sorry,
thanks so much.
thank you for the question.
That's a pretty cool demo, and I just wanted to learn a little bit behind the scene, like for example, the AI, who built the AI, how the money goes to the AI chatbot.
Okay, so we built a protocol that kind of takes Interledger on the one side and takes HTTP on the other side, and essentially you're making REST calls, so you're making API calls to these backends, and the first time you make the call, they'll respond with 402 payment required, which is a sort of an error code in HTTP that was already reserved, and we were like, great, that works for our use case. And basically, it sends you back a header that tells you all the information that you need to know to make Interledger payments to that exact endpoint, or the API server that runs that endpoint. And so that server will be listening for Interledger packets in addition to the HTTP requests. And so when you start paying, yeah, it'll go back into that same receiver, and then the receiver will then credit your, what we call like a token. And then the next time you make a request, it has in the header your token, and so the receiver will know that you've actually funded that with some packets, and then you can proceed through the program. The streaming version of the demo that you saw, that's a little bit more complicated. This probably goes a little bit beyond, but we can maybe catch up about it later. And then one thing that's also interesting is that one of the services, which is the thing that builds a static site into a Docker container, actually itself pays another API, right? So you have another API behind that. And so one of the things that's really cool is with these streaming payments, we can actually have sort of an API that takes in money and then immediately spends it as it's trying to process the request, and then maybe sends a little bit as profit to the developer, and then returns the result. So there's a lot of cool stuff you can do with it.
Great, thanks.
Thank you guys for coming to speak today. I'm kind of curious to learn more about how you might prevent money laundering and companies that participate in, like the payday loan type companies from coming on the system that exploit people financially. I'm interested to learn more about that sort of thing.
Yeah. So I mean, I think we really try to focus on, kind of the bottom of the payment stack, so kind of on the infrastructure part of it. And again, a reason for that is that a lot of the things that prevent bad things from happening are kind of top of the stack. And a lot of that actually doesn't need to be reinvented, right? And the way we kind of think of it is like, let's focus on what's really changing. And we think this is the interoperability. It's the idea of a digital asset with no counterparty that can be sent anywhere in the world that's neutral. So those are the things I think we can change, and then piggyback off of. This is what we like, kind of the enterprise focus now is for that as that first beachhead. Piggyback off of what already exists for hundreds of millions, of people. The other thing I would say is that if this Internet of Value becomes a reality, I think the prevention of things like payday lending, obviously that has to be regulated. That's a big part of it at every level. But the other big thing, to what Stefan mentioned before, is sort of the commoditization of reach. if you have that, you suddenly now, every market has way more competitors for financial products. And it was something we saw at Prosper and Elon we got frustrated with because we were kind of US only. You couldn't transport it to another market because you were in another network, right? This future vision, I think, is that the world is one big financial supermarket, and everybody's competing in every market. I think that goes a long way. But you still need all the other kind of regulatory components pretty much existing. Some may go away, but I'd say probably most of them don't. I don't know what you want to add to that.
Yeah, I think like with you mentioned anti-money laundering. I think there's sort of a long list of things that are actually completely separate issues, right? There's sort of consumer risk. There is anti-money laundering. There is anti-terrorism, finance. Like there's all kinds of different things that you have to think about when you're building a payment system. And so if you have a stack like this, they'll fit in different parts of the stack. Like for instance, consumer protection, that would fit in the application layer. So if you're building an application where consumers are sending money, you have to think about how to protect those consumers from sending it to the wrong people. If you think about risk, like counterparty risk, that would fit in the sort of the ledger layer, right? So you have a counterparty, they settle with you on a certain schedule. How do you make sure they actually settle with you? So there are a myriad of things to think about. I think that it's kind of illusory for us to come up with all the solutions. I think we're trying to be thoughtful in terms of like getting it to a point where we can start experimenting with it and kind of get more experience with it. But that's going to require sort of a commercialization of the technology to really think about all of those use cases. And I would also highlight that Ripple has a commercial stack and a commercial feature set, and that is very much like Chris said, riding within the existing regulatory framework. And then we have the open protocols, which are maybe a little bit more forward-looking, and I think some of those questions are more difficult there. So what you saw us present today is the more forward-looking stuff. So I think some of those questions are still open there.
Right. Thank you very much.
Thank you.
Hi, thanks for the presentation. So since the tech is currency agnostic, what would be the incentive to choose XRP over Fiat or any other cryptocurrency?
So this is where I'd almost love to ask my colleague up on stage, because we have our team who's actually trying to integrate with these different digital assets and different payment systems, and it's just like a many orders of magnitude of difference between XRP and, let's say, Bitcoin. And still several orders of magnitude between XRP and something like Litecoin, which is known as a more efficient sort of asset. And it's just a pleasure to work with. And part of it is it's been designed for that, right? Like it's been designed to be used as the settlement asset in Interledger. And so it has a lot of functionality like payment channels built in a certain way that are incredibly efficient for this particular use case. And so I think the big answer, the main answer is right now it's just the best thing to use. Like we talk to people, hey, let's set up a connector. Well, what do we peer with? Well, we could use Litecoin, or we could use XRP, but XRP will just be cheaper. So let's use XRP. And so I think as much, to the extent that these connectors are going to be competing with each other and they're trying to think about their margins, XRP is just going to look like a very good option for them.
Yeah, in this world, you'll need some digital asset that is super fast, super cheap, endlessly scalable. That will serve the world very well, right? Better than, let's say, using a dollar or using a euro, right? Something that is neutral to any network. So we're absolutely confident that some digital asset will be a key part of this Internet of Value. But we think that sort of fast, cost and scalability are going to be those key things. And that's what's going to drive the liquidity that's going to make these things really useful.
Yeah, and XRP is not static either. It's like we're constantly thinking about how to help improve it. There's a community out there that's thinking about how to improve it. So you can expect that it will get better as well as time goes on.
Final question?
Hi. So I was listening in the very beginning of your presentation about how you think XRP is better over Bitcoin, in the sense that Bitcoin is a lot slower, a lot more expensive. But but it is there for a reason, right? Because it requires like at least 6 confirmation across the network in order for a transaction to happen, and that is there in order to address the double spending problem. So I was just curious, like in your own words, how does that XRP address the double spend problem if it's just a confirmation between the 2 nodes?
Yeah. So if you're not technical, please, do something else for a little bit, because there's no way to answer that question without getting into some of the technology. So Bitcoin uses a consensus process, which is essentially based around the assumption that a majority of hashing power will never be held by a coordinated malicious attacker. And so if you're watching what the majority of hashing power is doing, you'll tend to be on a state of the network that is reasonable and doesn't contain reverted transactions and so on. However, the protocol as such does allow rollbacks, right? So you can, if somebody else presents you with a chain that's longer, has more hashing power behind it, you will roll back your transactions and switch to that. And I know that because I was one of the first people to implement a full node Bitcoin reimplementation from scratch. So I wrote that code, and it's very complex, annoying code to write, so I will remember that forever. On the Ripple side, such code does not exist. There's no way to roll back the network. Now, how is that possible? Well, the way that Ripple works is, as I mentioned before, the users select these validators, and then we essentially use that input as an input to sort of an algorithm where we look at the graph of what people selected, and then we run a consensus on validators that are central to that graph, or like that are highly trusted within that graph. And so it's sort of this 2-step process. And what that means is that when the first step is complete and you have identified which validators you're looking for, you don't have to worry about there being like more hashing power just over the horizon. Like once you hear from the validators that you've identified as being the ones that are validating, or like the ones that you're listening to, then you don't have to worry about some other validator coming in later saying like, no, actually we decided this, you just didn't hear about it yet. And so there's no need to roll back or to rewrite history. Once validators have committed to a decision, they can't change their minds essentially. And so that has a couple of impacts, or like a couple of ways that the protocol is different because of that. Number one, you only have to wait for one confirmation. You wouldn't wait for multiple confirmations because validators can't change their mind. You can't roll back, so there's no probabilistic aspect to it. Number two is we can process, or we can create blocks on a cadence, so we can create blocks on like a fixed interval, as opposed to a random interval like Bitcoin, where blocks can come out very close together, or there could be no block for a long time. Because we know which validators are supposed to generate blocks, they can generate them on that cadence. And then finally, I think, did I cover everything?
Yeah.
Yeah, whatever. There's a really good talk on, I shouldn't call it really good, but there's a talk by myself on consensus that you can find out from the Consensus 2017 conference, where I go into a little bit more detail. And I'm also happy to talk to you afterwards, but that's kind of the high level, quick description.
Cool. Chris.
Said that, yeah.
Guys, thank you so much for coming. Do you have any final statements, or do you want to tell people how they can get involved in the Ripple community at all?
Yeah, so for Interledger, there's interledger.org, which at the time of recording is horribly out of date, but hopefully by next week should be showing all the latest greatest stuff. There's a community group at the W3C called the Interledger Community Group that's open to anyone to just register. We have a mailing list where we discuss how all these protocols work together. All the code for the demos and everything, you can find that on github.com/interledger and /interledger.js. And then for Ripple, ripple.com, if you're a bank, let us know. Reach out if you're a payment provider. Maybe if you work for Google Payments or anything like that, let us know. And then there's another project which we didn't really mention today, but that's also was also used in the demo in the background, which is called Codia. So that's basically the hosting system that's paid with Interledger, and we uploaded the website to it. There's a lot of cool use cases around hosting, if you think about serverless hosting, et cetera. So if you're into that, there's codius.org as well, codius.org.
Awesome. Chris, Stefan, thank you so much for coming.
Thank
Really
you.
appreciate it. Give it up for them. Absolutely.